Good evening, class, and welcome to our management information class for today. We are going to be taking the topic marginal costing versus absorption costing. Okay, so last time, especially that is last week, I have a message here. Thank you. Good evening, kindness. Good evening. Last week, we had two lectures. The first one was on relevant costs. Then we now entered absorption costing versus ABC. Now that's a very important topic you should note. It's usually tested frequently in MI. Now we want to go into marginal costing versus absorption costing. Okay. Now let's look at some definitions. What is marginal costing? When we say marginal costing, we are also talking about variable costs. So when we say marginal costs, we mean variable costs, because marginal cost of an item is the extra cost of producing one extra unit. And what's the extra cost of producing one extra unit? Is variable costs. We also have what we call marginal cost of production. Now let's leave the word marginal out of it for the moment. Production costs includes direct materials, direct labor, direct expenses, and production overheads. Now, production overheads could be variable production overhead and fixed production overhead. Now, when we bring in marginal production costs, we mean all the items of production that are variable in nature. And so we have direct material, we have direct labor, we have direct expenses, then we have variable production overhead. So we will not include the fixed production overhead because it's not variable in nature. Now, when we say marginal cost of sale, I want you to first of all remove the marginal and look at cost of sale. Cost of sale, we will need our direct material, direct labor, direct expenses. Henceforth, I'll be calling them prime costs. We will need also our variable production overhead. You know, from these direct materials down to variable overhead, production overhead is our marginal production cost. Now, by the time we add other variable overhead, for example, selling and distribution costs, we will have our complete marginal cost of sales. All right, marginal costing and its uses. What are some of the uses of marginal costing? Okay, it is an alternative to absorption costing. You know, the last time we learned about absorption costing, we said it is full cost method. We looked at ABC and we look at the normal absorption cost. And we said we use it to measure the full cost of a product. But now marginal cost is an alternative which do not measure the full cost. And so you measure only the variable item. You measure only the variable item. Okay? What are some of the reasons we have for using marginal costing? One, we use it to measure profit or loss. We use it to measure profit or loss. And so when we are using it as an alternative to absorption costing, it means that in absorption costing, we have net profit. In marginal costing, what we have is not net profit, but it's called marginal profit. Now, there is another name for marginal profit, which is contribution. So contribution is another way of profit. That is the marginal profit. It's called contribution. Then we have another reason for using marginal costing is to be able to forecast future, what future profit will be. You know, when you are learning CVP analysis, that is cost volume profit analysis, you use the contribution principle, which is one thing about marginal costing to enable you to project or forecast what future profit will be. If you produce a particular volume of goods, if you meet a particular cost threshold, what will your future profit be? So it also helps you to calculate the minimum sales volume that you must make in order to make profit. That's what they call break even. Okay, we can also use it in budgeting and decision makings. What are some of the assumptions we will assume in marginal costing? Now, these are the popular assumptions that marginal costing takes into consideration. One, every additional unit or of output or sale, every additional unit of output has the same variable cost. What does it mean? It means that the variable cost of a product is constant. Let me give you an example. You have variable cost of making bread as 10 naira. Okay, now you've made 100 loaves of bread. 10 times 100 becomes 1,000. If you want to make an additional 1 loaf of bread, it's going to cost you 1,100. Now, what's the difference between 1,100 for 11 loaves and 1,000 for 10 loaves? It's 100 naira. Just that one additional cost, one additional unit is giving you the same variable cost. What does that tell you? It tells you that variable cost for each unit is constant. So anywhere you take it to, 1 loaf of bread, 100 naira. Second assumption, fixed costs remains the same in total terms, irrespective of how many units you produce. Okay, let me use example of a Zoom class here. Let's assume we use 10,000 naira to purchase a Zoom license. Now that's a fixed cost. So if that's a fixed cost, it means that if we have 100 participants in a Zoom class, which is a capacity, if we have 50 filling the class, we would have paid that 10,000 naira. If we have 25, we will have paid that 10,000 naira. Right now, we are in the class, we are 4 in number, we still incur the same amount. If nobody comes, we incur. When we are just only 2 students here, a lecturer and a student, we incur the same amount. So fixed cost is constant in total terms, irrespective of how many you produce. You see, variable cost is constant per unit. Fixed cost is constant in total. And the third assumption is Whenever you have a mixture of fixed costs and variable costs fused in one cost, which we normally call semi-variable, or which is called stepped costs, we can break it down into their components, called the fixed cost and the variable cost component. We use methods such as high or low or regression analysis to do just that. I think in a future lecture, we are going to see the high or low method of doing um, mixed costs. That will be under cost behavior. All right, let's go to one key concept that helps us to understand marginal cost, and that is contribution. I mentioned before that contribution is what we call marginal profit. This is because in deriving contribution, there is no consideration of fixed costs. Normally, we say profit is sales minus costs, and that cost could be variable cost and fixed cost together, which gives you profit. But when you strip out the fixed costs and you say sales minus variable costs, you get marginal profit, which is called contribution. Now, there are several ways in which we can get the contribution of a product. First one is by using sales minus variable costs. Now, when we say sales, we mean total sales revenue minus total variable costs. The second one is using to get contribution per unit. So you may need to say sales per unit or selling price minus variable cost per unit. That will give you contribution per unit. Now, when you get contribution per unit and you know the total volume of which you're going to produce or sell, you can multiply your contribution per unit with your volume to get total contribution. Another way of getting your total contribution is by going through the back door. We know that total contribution minus your fixed cost, that is a way of bringing your marginal profit to your absorption profit. So your marginal profit, which is total contribution, minus the fixed cost, will give you your net profit. Making contribution subject of formula, you have profit plus fixed costs will give you total contribution. So it means that whenever you have a contribution and your contribution is equal to your fixed cost, your profit is zero. Because let's say your contribution is 100 naira, your fixed cost is 100 naira, contribution minus fixed cost will give you zero. So whenever your contribution is equal to your fixed cost, you have no profits. But whenever your contribution is bigger than your fixed cost, what it means is that you have made enough contribution to cover your fixed cost, and any extra you make over and above your fixed cost will increase your profits. Now we want to look at how we can write profit statements using marginal costing. Okay, what the financial accountants do is to write their profit statement using absorption costing. But because of decision making, management can also do marginal costing reporting style. Now, that means we must make judicious use of total contribution. Total contribution. And I said total contribution is what we call marginal profits. Now, Look at example MCO1. The figures here are assumed figures. Your sales is 360,000. Okay, that's your total sales value. Now, all your direct costs here includes your prime costs. That is your direct material, your direct labor, your direct expenses. It gives you 105. Then you now add your production costs. When you add your production cost of 15,000 to 105, of course, that is 140, 120, 120. That 120 is what we call marginal production cost. Marginal production cost. Now we also have things that are not production costs by nature, which is selling and distribution costs. We now bring our variable selling and distribution costs, and you add it to that 120, it becomes 130. That 130 becomes your total marginal cost. Your total marginal cost. Now, your total marginal cost is the same thing as your total variable cost. So when you take away your variable cost of 130 from the 360, you are left with your marginal profit, which we call contribution, of 230. Now that you have your marginal profit, take away the fixed costs. So you have to do the marginal first. And when you get your marginal profit, which is contribution, you must be showing contribution before you start dealing with your fixed costs. So when you take away your fixed cost of 150, you are left with a profit of 80. And so you see how we can convert absorption costing to make absorption costing style to marginal costing style and get the same answer, but with different arrangements. Okay, so now if you are to arrange your absorption costing using these same figures, you are going to get the same profit of 80. But there are some situations you may not get the same profit. Now, the reason why you will have the same profit is because there is no stock. There is no opening stock and there is no closing stock. In this lecture, we are going to deal with stock and how we can account for it when we are using marginal costing and absorption costing. Now, look at example MCO2. In example MCO2, a company manufactures and sells two products, A and B. Product A has a variable cost of 6 naira and sells for 10 naira. So that means the selling price here is 10 naira, while the variable cost, which is a marginal cost, is 6 naira. That means your marginal profit or your contribution per unit is 4 naira. So this is the first method, is what we call the total contribution style. It's called the total contribution style. Now this one we are doing now is the marginal, what do they call this? The contribution per unit style. Now you've gotten your contribution per unit. Let's read on. Product B has a variable cost of 8 naira, which is this 8 naira we have here, and sells for 15 naira, which is this. And so we have our marginal profit per unit, I call it contribution, 7 naira per unit. That's not all. During the period, 20,000 units of product A, which is this, and 30,000 units of product B, which is this, were sold. So it means The assumption here is these are the quantities that were produced and sold. Now, once again, we are not dealing with stock. There is no opening stock, no closing stock. So what does that mean? It means if you have your contribution per unit of 4 naira, you can easily multiply it by the quantity sold to get your total contribution for product A. Applying the same method, 7 naira multiplied by 30,000 units will give you 210,000 naira. So when you now add the 280,000 plus 210,000, it gives you 290 total contribution. Okay, now they said fixed costs were 260. Now you see, we've demonstrated the fact that fixed cost is fixed in total terms. So you cannot be saying fixed cost per unit here, fixed cost per unit. But you see variable cost, it will give you per unit. So you see fixed cost is total you usually get. And so when you less it from the total contribution, you have a profit for the period of 30,000 naira. Now we've been dealing without stock. We've not been dealing with stock. So what do we do when we have stock? How do you account for opening stock and closing stock? Okay, a marginal income statement with opening and closing inventory. Normally, when we do absorption costing, which is what the financial accountants do, the production cost of sales, which we normally less from sales revenue to get our gross profit, we normally calculate it as follows. We get our opening inventory value. We now add our production cost incurred in the period, and that will include direct material, direct labor, direct expenses. We now have our production overhead. That means the production overhead is variable and fixed. You add them together, gives you production costs. Then you didn't sell everything, so you need to less the closing value. That gives you your production cost of sales. The same principle applies in marginal costing. Now, the only difference between absorption costing, cost of sales, and marginal costing, cost of sales is one, there is no fixed production cost. And because there is no fixed production cost, the opening inventory value will not be valued at full cost, but at marginal cost. The closing inventory value will not also be valued at full cost, it will be valued at marginal cost because your production cost will only be variable production costs. Unlike for absorption cost where you have the full production cost, which is inclusive of variable and fixed. Whenever marginal costing is used, inventory is valued at its marginal cost of production without absorbing any fixed production overhead. Now, look at how marginal profit statement or income statement is being demonstrated here in MC03. Okay, marginal costing income statement for the period. Now, these are assumed figures. Look at your sales is 440,000. You now have your opening inventory. Note, this opening inventory does not have elements of fixed costs. It is valued at variable production costs. Now this is 5,000. Now, your variable production cost is as follows. We have your direct material, 60,000, your direct labor, 30,000, and your production overhead, variable production overhead. When you add all these together, you have 110,000, which includes the opening stock. Now, this is the whole 110,000. If you have sold everything, that would have been your cost of sales. But you didn't sell everything, and so you have a closing inventory. That closing inventory, how do you value it? You value it at your variable cost, variable production cost. So that's 8,000. So you are now left with 102,000. This 102,000 is your variable production cost of sales. This is your variable production cost of sales. So in all your production process, the variable aspect has given you 102. We still have some other things you need to spend before you sold the item. These are selling and distribution costs. The variable part of it is 18,000. So when you add your 18,000 to your variable production cost of sales, what you have as a whole is your variable cost of sales, otherwise known as variable costs. Your total variable cost is 120. When you take away 120 from 440, you have your variable or marginal profit or contribution of 330. This 330 is your marginal contribution. You will now start dealing with the fixed costs. Remember, production has its own fixed costs, which normally in absorption costing, it will go to production cost of sales. But in marginal costing, you've separated it. The fixed cost is 120. Admin cost, which is usually 100% fixed. Yeah, it includes salaries, include maybe data, include every other thing that admin people spend on. So it's 100% fixed. Then you have your selling and distribution costs. Normally, some parts are fixed, some parts are variable. Dealt with the variable part, now is the fixed part. So your total fixed cost happens to be 280,000. When you less it from 320, all you have is 40,000 as your profits. So you see how marginal costing style is. You treat your variable overheads and your fixed overheads separately. Now, assuming that you were given variable overhead, production overhead, you were given a particular figure and you were told it was mixed cost, and they gave you for several years or for several months, and you know it was mixed cost, you can use your high or low method to remove the variable parts from the fixed parts. So anytime you are giving costs combined, it is not separated, variable and fixed together, and they didn't give you any way on how to remove them, you can use your high or low method. Look at example MCO4. Now, MCO4 is the alternative method, which is now the absorption costing method. Mind you, this topic here is marginal costing versus absorption costing. Now we've seen the marginal costing profit statement style. Let us look at the absorption costing statement style. Now, all these things I'm saying is just for you to be fully aware, because you may be given an exam question and you'll be asked to prepare a profit statement. You can use the absorption costing style. You can use the marginal costing style. Okay, but I'll tell you how to know which method to use. All right, all these are assumed figures. Your sales is 430 as usual. Your opening inventory is 8,000. Now this is at full production cost. That means both variable costs and fixed costs are involved. Now the same thing here with your closing stock. So that's the point I want to make. And look at this production overheads. We have both fixed costs and variable costs in here. Unlike the marginal costing where you separate them and you put the marginal first and the fixed down. Here you join them together as long as they belong to production. And so what you have is your full cost of sale, production cost of sale. When you less it from 430, that is less 184 from 430, you having 246, which is your gross profit. I will usually call it absorption gross profit. Now, there is a comparison here. This 100,000 is 100,000 here. And now, this is the same 100,000 here, which you have absorbed. Now, because you have absorbed this, and this is your production overhead incurred, it means that you have an overabsorption of 5,000. You add it to that, and it gives you 251,000. Then you now get your admin and distribution, admin selling and distribution costs. You less it and you get your profit of 73,000. Now notice here that the profit here will be different from that of marginal costing because of the way we have valued our opening stock and the way we valued our closing stock. And that's the major difference. In a future lesson, we are going to be looking at stock valuation. How do we value our stock? So I'll be showing you that in a future lecture. Then, now look at how we look at this example MC05. Let's take a question now. This is Makurdi Manufacturing makes and sell a single product. Now this single product has a selling price of 150 naira. Okay, now direct material per unit is at 35 naira. Direct labor is 25 naira per unit. The figures we have here is per unit. Variable production overhead is 10 naira. Notice here fixed overhead is not given here. So when you add 35 plus 25 plus 10, it gives you 70 naira per unit. Now look at what it says here. Marginal cost per unit, yes, which is used in your inventory valuation. What it means is that you are going to use 70 naira as your cost, marginal cost per unit, which we use in valuing your closing stock or your opening stock. Now we said here, budgeted fixed production overhead. It is budgeted at 110,000 naira per month. And they said the following actual data relates to July and August. So we have 100,000, 110,000 as our fixed cost, fixed production cost. Look at your production, you have 2,000 units as against August of 2,500 units produced, and you sold 1,500 units here and 3,000 units. Let's analyze this before we proceed. They said there was no opening inventory in July. So there was no opening inventory. But there is a closing inventory in July. Look at it. You had nothing before, and you now produce 2,000. So 2,000 is in your store. At the end of the year, you find out that you sold only 1,005. It means that 500 is closing stock. So if 500 is closing stock in July, 500 will become opening stock in August. So you have 500, which you take to August. You have 500 now. You went and further produced 2,005. When you add 2,005 to the 500, you have 3,000. And you sold 3,000. What does it mean? There is no closing stock in August. So if you look at it well, July has no opening stock, but July has closing stock. August has opening stock, but no closing stock. Okay, required. Show the profit statement for each month using the marginal costing method. So look at what we will do here. I'll be keeping the questions steady here. Then I will bring in the solution here. Let's go here now. So we'll be seeing the solution and the question side by side. All right. Sorry. Now look at the solution. We were told that selling price is 150 naira, right? So if we are to buy, if we are to sell 1,500 units at 150, it means our sales revenue will be 225,000. Now that's for July. Now, let's look at how we can get our variable costs. We'll start with production, marginal production costs. We had no opening stock in July, so it's 0. What about production? What do we do about production? We are told to use marginal production costs, which contains direct material, direct labor, and variable overhead. So we have 70 naira for 1 unit. When you use 70 naira for 1 unit and you produced 2,000 units, 2,000 times 70 will be 140,000. So that's how we got our 140,000 here. That is variable production cost. But we were told we have closing stock. We produced 2,000, we sold 1,500, closing stock is 500. So how do we value our closing stock? 500 multiplied by this 70 naira. So 500 times 70 naira will give you 35,000. Okay? Now 35,000 is deducted from 140. You have your 105. Now this is your marginal cost of sales. Just a moment. So you have your marginal cost of sales. Your marginal cost of sales here is 105,000. Now you have no selling and distribution costs, so we put 0. Normally, I'm not supposed to show this, but just for the sake of giving you a format, now it becomes 105. Your total variable cost is now 105. When you deduct 105 from 225, you have 120 as your contribution. Now this contribution is what your total contribution. You were told in the question that your fixed cost is 110. So you remove 110, your profit is 10,000 naira. Now that's all for July. You now go to August. So you use a columnar method. You go to August, and how many did you sell? You sell 3,000 units at 150. So 150 times 3,000 will become 450,000. And that's how we got 450,000 here. Now going to production costs. We said opening stock. So this closing stock in July, which was valued at marginal cost, is now your opening stock in August. That's fine. Then you have your production. What happened to production? You produce 2,500 units. Now, because we are using marginal costing, you're going to multiply that by 70. And when you do, you have 175,000 as your production. We also told that because you had 500, which was added to 25, and you sold 3,000, there was no closing stock in August. And so in August, closing stock becomes 0. If closing stock becomes 0, what happens when you, sorry, this is your closing stock here, becomes 0. So when you add everything and less 0, you have 210. 210,000 is your marginal cost of sales. Notice here that there is no selling and distribution cost. So this 210 that is here remains the same here. This 210 now is your variable cost, which went less from sales revenue of 450. You have 240,000 as your contribution. Mind you, the question gave you a fixed cost of 110,000, which you are going to use now. Less it from 240, you have 130 as your profit. Okay, that being said, let's look at the alternative method using the absorption costing. Now we are given the same set of information, the same set. Can you see the 70 naira that we are using here? This is your marginal costing value. Now we now have fixed costs per unit, and they told us how we'll get it below, and we are told it's 50 naira. So in a moment, we're going to look at how we got the 50 naira here from the question analyzed it for you. And that is how it is usually done. So when you add 50 to 70, you have 120. And notice here, it's going to be used in valuation. That means you are going to be valuing it at your total cost. Now, let's see how we got our 50. Normal production was budgeted to be 2,200 units every month. And your fixed cost per unit, per month, is budgeted at 110. So it means if you have 110,000 naira budgeted and you are budgeting to do 2,200 units, it means what you budgeted as fixed cost is 50 naira for every 1 unit you produce. So that's how we got our 50 naira we use there. That's interesting. Okay, now let's look at the following data relates to July and August. The same figures, everything. So I'm going to be showing you what to do. I will just show you where the difference lies. Where the difference lies. Okay, so this is the question here. Let's show you where the difference lies. You notice in July, our 225 sales revenue is still constant. Our 450 in August is still constant. Beautiful. Another thing that is also constant is this production cost. Now, this production cost and here is also constant. Then we have our opening stock. This opening stock is valued at 120. You value it at 120. Okay, but here we have no opening stock, so your closing stock is valued at 120. So here it's valued at 120. It takes it here as opening stock, and you add them to your. So this production here is variable production costs. So variable production cost is at 70 naira. This is your fixed overhead production cost at 50 naira. That is what makes it 120. So if these two production costs is valued at 120, of course your closing stock should be valued at 120. If this and this are valued at 120, of course your opening stock should be at 120. And so it gives us gross cost of sales 190 here, gross profit is 35, and your profit is 35 here, and 105. Now, can you see something here? I'll be bringing these two side by side so that we'll be seeing something which I want to highlight. If you look at the profit in July is 10,000. The profit in July here is 35,000. It means absorption costing has a higher profit than marginal costing. Now look at for August. The profit here is 130 for marginal, for absorption is 105. The same figures we use all through. But what's the difference? Why are they having different profits? The culprit lies with how we value our stock. How we value our stock. So the culprit lies with closing stock and opening stock. Now let's look at the difference. Now, whenever you have opening stock, let's start with closing stock. Whenever you have only closing stock, as in this case here, you have only closing stock. What happens? What is the effect of just having only closing stock on your profits? If you look at it now, if you have closing stock alone, can you see it is reducing your cost from 140 to 105? And in this case here, it is reducing your cost from 250 to 190. So it shows you that your closing stock tends to reduce your costs. And what does a reduced cost have on profit? Whenever your cost is reduced, so you see, if your cost is reduced, if your revenue is kept constant and your cost reduces, your profit will increase. Your revenue is constant, your cost increases. Your cost is supposed to be deducted from revenue. So that means if your cost reduces, your profit will increase. And what makes it possible? Closing stock. Closing stock reduces your costs. Can we please off our audio? Can we off our audio? Okay, that's taken care of. We said closing stock reduces our costs. And when it reduces our costs, it increases our profits. What is the take home there from it? The higher your closing stock, the higher your profits. The higher your closing stock, the higher your profit. So can you look at it now? Here was 35,000 and here was 60,000. And we said the higher your closing stock, the higher your profit. So you see 35,000 here as against 10,000. Now we see there was no opening stock. We're just comparing only closing stock. So when no opening stock, when your revenue is constant and no opening stock, the higher your closing stock, the higher your profits, because your closing stock will reduce your costs and increase your profit. Let's look at the other side. Let's assume we have no closing stock, but we have just opening stock. What does opening stock do? Opening stock increases your costs. So you see, there is your normal cost is supposed to be 175. Now, when you have added opening stock to it, it has increased it to 210. And what does
What's going on? Is it network that made Mr. Chima log out? I don't understand.
Sorry for the break in transmission. I'm back now. Okay, now we've been describing when there is no closing stock and there is opening stock. And we said when there is opening stock, it increases your cost. And when your cost increases, your profit will reduce. So what does opening stock does? Opening stock increases your costs and reduces your profit. So anything that increases your costs will reduce your profits. And that's what opening stock does. Anything that reduces your costs will I'm so sorry. I don't know, kindness. Each time my network goes off, yours goes off. Are you using my network? I wonder. All right, let's go on. So you see that 60 is higher than 35. And so the profit for 60 opening stock is lower than that of the profit of um, 35, which is 1/3. Okay, I'm so sorry for the network challenges. I was explaining that whenever you have opening stock and closing stock together, you need to look at the net effect. So if you look at opening stock and you compare it with the closing stock, it means that, let's say, for example, your opening stock is 60 and your closing stock is 35. What you do is you bring your opening stock and less your closing stock from it. If you have a positive figure, that means your opening stock is more than your closing stock. That means the net effect is that it will behave like opening stock characteristics. And how does opening stock characteristics do? Okay, let's say you have 60 opening stock and you have 35 closing stock. The difference is just 25. So if opening stock increases your profit, no, if it increases your cost, it means your cost would have been like increased by 25. And it means that your profit will be like reduced by like 25. Now, if your opening stock is lower than your closing stock, that means when you say opening stock minus closing stock and you have a negative figure, that means it behaves like closing stock. And when it behaves like closing stock, it means your profit will increase. Now let's look at the advantages and disadvantages of absorption and marginal costing. Let's look at the advantages of absorption costing. One, inventory values includes elements of fixed costs. And this is consistent with what the financial requirements are for financial accounting. You know, there are some people who are users of accounting information, so you want to show the true picture by including fixed costs in your costing. So it is not only management that is looking at it, tax people are looking at it, government, the shareholders, potential investors and others are looking at it. So reporting it in absorption costing way gives a true picture. Now, calculating of under or over absorption can be useful in controlling your fixed costs. So when you know you're over absorbing your fixed costs, you know that you are budgeting too much than what you are spending on. So you need to control. And when you know that you are under absorbing, then you may need to take necessary action. Okay, now it will be easy to get good selling price when you are calculating full cost of a product. So it is going to help you to get the selling price that is possible to sell a product. There's no way you can be getting your selling price when you are just using marginal costing. What are some of the disadvantages? Absorption costing is a more complex costing system than marginal costing. Okay? Absorption costing does not provide information that is useful for decision making. And that's the major disadvantage I pick from there. Look at marginal costing. What are the advantages? It is easy to account for fixed overhead using marginal costing instead of apportioning it the way we do it in absorption costing. So it is easier you separate your fixed costs and treat them separately from your marginal cost. So it is helpful to make management take decision, okay? Because they take decision based on variable cost and not on fixed cost. And now because there is no over absorption of overheads, so there is no necessary to adjust the income statement. Now, marginal costing is useful for decision making. And when you use the contribution per unit, it can help you to forecast sales. It can help you to look at profit how profit per unit varies with volume, which we will learn in CVP. Disadvantage is that it does not go in accordance with the requirements of financial reporting. And so you can also, it's going to be confusing to other users of information to not to see fixed costs. They're only seeing variable costs. You tell them marginal cost this, marginal cost that, and it's going to be confusing. All right, marginal costing can be used to measure contribution per unit of a product or the total contribution earned by a product, but it's not sufficient to tell you whether the product is profitable or not. Okay, so add to that, it is not easy to get selling price using the marginal costing method. So far, so good. We've discussed the concept of marginal costing. We've seen how we can calculate marginal costing given a cost data. We have seen how we can find contribution. Contribution is the most important thing here. We have seen examples of how we can absorb our costing using absorption costing. How we can get our profit using absorption costing, how we can get our profit using marginal costing. We saw how we can how we evaluate our costs, our closing stock using absorption costing, using marginal costing. We also saw how we can account for the differences in profit because of the opening stock and closing stock that are being valued differently in these two methods. So far, so good. We've come to the end of our class. Please go through this lecture again. If you have any question, feel free to ask me. Please also go through past questions to see questions you can solve that relates to absorption costing and marginal costing. I want to take my leave now before the network throws me off. So sorry. Please ask your question in the WhatsApp class. I'll be glad to answer them. Thank you so much and do have a lovely day.